Hello and welcome to OMG Market Analysis for Beginners. I'm a beginner and we're going to do a quick recording here. Market Scan Dogma. We're going to look at Finviz a little bit more since I bought the Elite package and I noticed they had a backtesting tab. And I was doing my last video was on scripting and ThinkScript, which was really going to go towards backtesting eventually, because you would want to do that before you put something into full motion. So let's get right to it. Our dogma before we go into the backtesting is look at the economic calendar, consumer confidence report, look at these reports. Don't know why, just look at them, get used to looking at them. Let's see, this one went up. We've got manufacturing index, jobless claims, which is all related to inflation and whether or not we're getting into recession yet. The other thing is to look at Finviz and go through the menus, highs and low tickers if you want to look at that. Some news, scan through the news. Charts, we haven't done that yet. I usually do that on Yahoo. This looks like a pretty good one. Might have to look at it eventually. Go through the maps, kind of a muted red day. Energy took a bigger dump today. It's been really hot lately, and so now it's deeper in the red. That could be related somewhat to Europe's story that the reserves on natural gas aren't so low as you might think. Telecom here, T-Mobile, AT&T are barely in the green. Bristol Myers Squibb and healthcare. Target, Walmart. EA Sports was in the green the other day. I don't see it now. Okay, groups. Everything's in the red. Everything's in the red. Energy is still the winner for the recent past. And then futures. Feeder cattle's green. Lean hogs is green. Live cattle is not so green. Lumber is down. Once again, the housing market is just bad news after bad news after bad news. The VIX has subsided slightly, which means things were not volatile today. And option prices are very slightly cheaper. Okay, let's get to it. Back tests. On Finviz, there's an elite section. I signed up for it. And then there's also, well, that's just to go. There's also this backtest package. Okay, when you go to backtest, your backtest will be empty, and then they have some presets. I went and right in here, and I started creating one. I thought, okay, I know what I want to do. And I ended up with negative 17%. I thought, gosh, I don't know what I want to do. And I started duplicating and tweaking the settings. Basically, I was trying to say whenever the moving average crosses over, the short moving average crosses over the long one, then I want to get into the stock. And then I have a stop loss of 3%. And after 10 days, whichever one hits, hopefully the 10 days hits, and then you get out. This was totally arbitrary, and I chose Apple even though the index is S&P. I didn't understand this stuff very well. This is what I wanted, cross, when it crosses, not just when it's greater than. But I'm not so sure that it's really that it really matters. Let's just, as a test, this one is negative 17.5. So if we change it to cross, still negative 17.5. So that didn't matter. So that, but I was we really want cross. That's when we want to make our trade. So then I was playing with them and I kept tweaking it, moving the numbers around, and I got up to 34%. How did I do that? Let's see. Um, and now this is running for 20 years, so it's not really the S&P, is like a 300, 200, 300% over that time frame, and I've got 34%. That's absolutely abominable. However, it probably max drawdown 38%. Yeah, this is just nowhere. This is after 20 years, you should obviously from 1996 to 2021, you should have a better return than that. Otherwise, why are you wasting your time? So, um, I went along, and as you can see, I got up to 73% here. Is that my best one? Am I even recording? Yes, I am. Okay. 73%, 65%. Let's look at what the 73% was. I believe that was over the course, once again, of, um, like 18 years. So that's still terrible. See, the purple is the S&P, right? And then the blue line is mine. So this is a really good thing to play with from scratch because you're like, oh, I think this. I think that also the Sharpe ratio and Kalmar ratio are something that you should read up on Investopedia or something. It's just basically saying how bad are the drawdowns, what is the ratio of gains to losses, stableness, stability, whatever, cost of, this is probably, compound annual growth. Okay. In here, you can also put your trading costs to mitigate that, but I put it at really low because trading is, pretty low these days. Um, anyways, my final test was at 66.9 and it was only 1 year. Um, Actually, it was only 10 months. And so this is the first one that I ever created that actually beat the S&P. And I thought, okay, I guess I'm starting to understand. I had to tweak, if we look at this. Oh, and this is just Oxy. Okay, so I changed the ticker to a ticker which has been doing well, doing better than the S&P. Okay, that's an easy win because this is hindsight. I also didn't have that high of a number. I had like 50% or whatever, and I got up to that high number by changing my exit strategy days for how many days that affects a lot. I didn't have a lot of stop loss percentage hits because changing this number didn't do that much. Also, this is really just closing price. Exponential moving average for 2 days is not, it's almost the same as your price for the day. I mean, it's not the same, but it's kind of close. And then we're saying crossing over the 20-day. If we do crossing over the 200-day, we're not going to get very many trades because it doesn't cross the 200-day very often. And then we're saying when it starts to go back under or when the 20-day comes to meet it, it's flattened out. Otherwise, if it takes 19 days, then just get out of the trade. Okay. And which is probably going to be a gain. So, because otherwise it would have crossed back down or the stop loss would have hit. I don't even know that the stop loss is hitting because in order to lose 5%, you would assume that the moving average would have crossed by then. Anyways, finally, after doing that, I was like satisfied. I was like, oh, I'm getting somewhere, okay? I'm learning this. I finally went over to this presets. I thought, oh, this is interesting. Holy shit. What is that? Right? And so I clicked in. I know what relative strength is, sort of. Okay, that's 3,000% return, right? And then I thought, okay, I'm not going to look at that. that makes me feel bad. Whatever. I am going to look at it, but first I'm going to look at a moving average one because that's similar to what I was doing, and it's 263%, and that's over the course of the 20 years. So let's take that, see how far the numbers are from what we were playing with, and then also shorten the date range down to see what we get if we get our 70%. We're trying to, so this is saying when the 100 is less than the today's close. I don't. When it closes above the 100-day average on any given day, you enter, which could be every single day of the month. It's very confusing. And then you exit when the close finally drops below the 100 days. So they're not using two crossing averages. They're using just the close, and when it's above, you enter and you enter and you enter and you buy and you buy and you buy, and then I think that's what it means. Okay, so this was 200 and some percent, right? So now let's change the day. We don't want to go that. Let's change it. Let's bump up to like 2012 first of all to see if our number goes down. This maximum min daily volume, we're not going to play with that. But I am going to shorten it just in case we add a ticker only. That way it doesn't, we don't forget. Okay, so now we're down to 158%. All we did was change the date range down to 10 years from 20 years. So that makes sense. And we're not beating the S&P. So we're already so this moving average thing is what it is. Okay, it's not beating the S&P. However, it may be less risky because you get out of trades, right? If you to get the S&P, you have to leave your money in permanently, right? Forever. You have to leave it in there the whole time. In this thing, you may or may not be in the market that much. So then your risk is less. So there is a factor there. It doesn't matter. It just depends. You just have to remember that that's the case. Now let's go up to what we were doing in our final thing, which was 2020. It was May 1st to March of 2021, which is like 10 months. The last time it doesn't go past March, so that kind of sucks. I wish it did. So this is where we had our 70%. And they only have 46%. So their back test, which is a preset, doesn't mean that they thought this was good. It just means here's an example of how to do it, right? Theirs is 46% and 11, and the Sharpe ratio is 2, Kalmar ratio is 3, and their compound annual growth rate 40%. Okay, so if I do mine, let's go back to my 73. Sorry. Right? Like, where are we here? Their max drawdown is less. Their Sharpe ratio is way higher. And their Kalmar ratio is way higher. I'm going to say that those are good things. And their compound annual growth rate 40. I don't really understand what that means. I'm going to say that means that they were in the market way longer. We weren't in the market that much. We got 73%, but only, well, I don't know. Anyways, it's interesting. It's interesting. So, how do I join that back onto there? Okay. So now let's go back to presets. Wow. Back to relative strength, because that's insane. Okay. Now the ratios are really low. I'm going to say that that means that you're not in the market very much. Max drawdown 60%. So what is this? Let's see how it. So they're saying when the relative strength for the 5-day period is crosses to be less than the 20-day period, means it's gotten. Then you enter, and then you exit when it crosses over the 50-day. Okay, so that's insane. All right, so that is 3,200. I just want to go into this other thing where you can type a ticker. Okay, so 33, whatever. We'll turn down this volume. Now it's down to 94% when we chose Apple. Okay. And this is it could be because those relative strength numbers don't really apply to a single ticker, probably, or something like that. But it also, let's go back to just doing this crazy one for, doing it for 25 years is pretty mind-boggling. I don't know that that's valid. So let's try this. What we were doing, we had the 70%, right, in the S&P. We got 71%. So now I'm feeling like a genius, even though when I ran mine for 25 years, it didn't work like that. But the ratio probably means that you're in the market a lot more. Max drawdown's way less, so this is really good. This is a great number. So this is a great back test. I mean, I don't have any idea. It could just be a default. The dummy back test they put in there, it's probably could be terrible. I don't know. Anyways, it's really fun to go in here, hit just all day long, hit duplicate, change this to, wait. What was that again? Running 71%, duplicate. If we change this, for instance, to 10, 70, what was that? 71%. Now it's 53%. Calmar ratio is 10. Calmar ratio is 8 and jumped up, but the ratio went down a little bit. What else can we change it to? We could say when the this is I really don't know what I'm doing. If we change these to 3, they probably already did that. Well, no, now it's 98%. So, that's interesting. And then the final thing I wanted to do was say, okay, now let's do Apple. 98. Now it's only 10%. Now, why is that? Why is that? That's what we don't understand. Okay. Tickers. Why is it just S4? Yeah, that doesn't make any sense. I think it's because these numbers are geared towards an index, not towards a single stock. So they don't really make sense for that. But the SPY is an ETF. So whatever. This is. There's also these tabs here, since I'm stalling out here. There's also these tabs which show you how many trades that your back test did. And then how many, if you stayed in the SPY the whole entire time, you took whatever you were trading with and you put in the SPY from day 1 in May and took it out on March of this year, right, or last year, whatever it was. And the volatility is of the days that you were in is higher. The max drawdown's lower. The total return is higher. So you can see just staying in the ETF, it definitely seems like you're getting a way better return than just staying in the ETF. Now, this was a good year. This is a good time frame for the SPY. You know, you made 11% in 10 months. It's certainly running this. It's really important to run this over the period of a bad period. You know, like let's go back because we want to know how much worse it did, right? Like go to 2008, 2010, and then we run it. We got 46% return. The backtest still did. Here's on the downswing, right? And then on the upswing, it did much better. On the downswing, it stayed roughly. It had some worse days. Let's shorten that date. Let's bump this back a little bit more to January of 2008. Bump this back to July 2009. Okay. I obviously wasn't following the market that closely back then. But this is a big down, down, down. And we can see that our study still made money. And the SPY certainly did not make money. Okay, it just fucking got hammered. Like it's no good. It's no good. So this is a good back test, and we can learn that we should think about RSI. We should think about it a lot. Okay, value 20. What is value 20? See, I really don't know what I'm doing. But anyways, there's more tabs here, and you can see the months that it did really well, the months that it did poorly. And that's it. That's the back testing feature of Finviz, and now I'm feeling pretty good about my $40 because I'm learning negative days, positive days. Yeah. So make sure to stretch your hands, roll your neck, and I'll talk to you next time.